Hello, everyone. Welcome to today's session on the basics of trust accounting. My name is David Cho, and I will be one of your presenters today. Before we get started with today's session, I'll give you a brief background about myself and Krista Adamek, who is the other presenter. I've been a trust auditor in the Trust Assurance Group since 2017. Prior to joining the Law Society, I worked in public practice at a Vancouver-based mid-sized accounting firm. My background is in public practice, consisting mainly of audit of engagements of public company and non-for-profit organizations, and I obtained my Chartered Professional Accountant designation in 2017. Our second presenter today is Krista Adamek. Prior to joining the Law Society in 2008, Krista worked in a large accounting firm in insurance and tax compliance. Since joining the Law Society, Krista has traveled around the province and conducted several hundred compliance audits. In 2016, Krista took the role of audit team leader and now spends most of her time supporting a fantastic team of auditors. Krista has presented on trust accounting in partnership with the Law Court Center, CLEBC, and the BC Courthouse Libraries. Krista has a Bachelor of Commerce from the Thompson River University and a Chartered Public Accountant designation. In 2017, Krista obtained her Certified Anti-Money Laundering Specialist designation. This is today's agenda. I'll start by giving a brief background about the Law Society of BC, what we do and why we do it. Next on the agenda is a trust accounting overview, defining what trust funds are and explaining 7 key concepts in trust accounting. This is followed by what to consider when setting up a trust account, such as banks versus credit unions. And our last topic will touch on operating a trust account, which includes a trust reconciliation. At the end of this presentation, we'll go through a brief summary of the topics presented today and provide contact information as well as links to various other online resources. So the Law Society, what we do and why we do it. The object and duty of the Law Society is set out in Section 3 of the Legal Profession Act. Briefly, this includes establishing standards and programs for education, professional responsibility, and competence of lawyers, regulating the practice of law, and protecting the public interest in the administration of justice. The Law Society is involved in issues affecting the justice system and delivery of legal services. The Law Society has a duty to ensure that lawyers can identify and maintain a high standard of ethical conduct. The Code of Professional Conduct for British Columbia, commonly known as the BC Code, attempts to assist lawyers to achieve that goal. It is published for the guidance of BC lawyers and articling students and is an expression of the views of the benchers about standards that lawyers and students must meet in fulfilling their professional obligation. While the code is comprised of 7 chapters and 5 appendices, you may especially wish to review the chapters set out in this slide, relevant to your practice as they may relate to your competence and responsibilities in the context of today's topic. Specifically, Chapter 2, the Standards of Legal Profession, sets out a general guide to ethical principles in the canyons of legal ethics and for integrity. Chapter 3 is the relationship to clients. It includes rules regarding lawyers' competence, quality of service, and confidentiality. Chapter 5 is the relationship to the administration of justice, which includes rules regarding ethical advocacy and incriminating physical evidence. Chapter 6, relationship to students, employees, and others, includes specific administrative staff parameters around supervision and delegation. And Chapter 7, relationship to the society and other lawyers, which includes lawyers' ethical responsibilities to the Law Society for regulatory compliance and a duty to report. So this is our first topic for today. It's the trust, just a trust accounting overview. In this section, I'll be giving a trust accounting overview. This will include discussing the Law Society's trust assurance program, defining what trust funds are, identifying where trust funds, where to find the trust accounting rules, and then explaining 7 key concepts in trust accounting. The trust accounting rules can be found in Part 3, Division 7 of the Law Society rules. Please note that the Law Society rules are not optional and they must be followed. Not equating yourself with the Law Society rules increases the risk of making errors that will seriously impact your firm. And a very important note is, although a lawyer may delegate his or her tasks, for example, the preparation of accounting records, however, ultimately the lawyer is personally responsible for those records. The Trust Assurance Program is designed to ensure lawyers handle trust funds appropriately and comply with the rules. All lawyers who handle trust funds for clients or third parties are subject to rigorous trust assurance standards. The program includes compliance audit, typically performed every 4 to 6 years, trust reports, such as self-reports or accountant's reports, which are filed annually, reporting requirements where applicable, such as cash or shortage reports, and education and outreach. So what exactly are trust funds? This is the definition found in the rulebook is trust funds are funds directly related to the legal service provided by a lawyer or law firm received in trust by a lawyer or law firm acting in that capacity. So what does this actually mean? Broadly speaking, trust funds can be held for two purposes: a financial transaction for which legal services are being performed on behalf of a client. For example, if a lawyer is assisting their client with the purchase of a home, the lawyer is able to deposit the purchase funds into trust to be used for this financial transaction. And then the other purpose is if a retainer is paid in advance of legal services. These are some important concepts regarding trust funds. The first one is trust funds are not the firm's funds. They belong to the firm's client. Only funds that are directly related to legal services provided by the lawyer or law firm can be placed into that lawyer's or law firm's trust account. For example, a lawyer helping a client pay their client pay monthly child support payments from trust is not considered legal services, and therefore the funds should not be placed into trust. Trust funds for retainers belong to the client until they are earned by the law firm. This means the lawyer must provide legal services and prepare and deliver an invoice to the client prior to withdrawing any funds from trust to pay their bills. And lastly, any balance left in trust for a particular client matter, once the file is complete, cannot be treated as revenue by the firm, no matter how small the balance is. The remaining funds must be refunded back to the client, or if you're unable to do that, there's an option to remit it to the Law Society under unclaimed trust funds. If the matter is closed, the balance must be zero. Therefore, it's highly recommended a lawyer deals with these balances while they're closing the file and they're still able to contact their client, because as time passes, it may be increasingly more difficult to locate a client. And here are 7 key concepts in trust accounting, which I will go over in detail. The first concept is separate client matter equals separate client ledger. So a good example of this is if a lawyer is assisting their client with the sale of their current home and the purchase of a new one. These are considered two distinct matters, as one is not reliant on the other. Therefore, 2 separate client ledgers are required. The purpose of separate client ledgers is to ensure trust funds for one matter are not mistakenly used to pay the obligations of another. Another example could be if a lawyer has allocated money for their client to pay a settlement, the lawyer can now not take these funds and apply it to, say, a purchase of a new home or to pay their invoice. The client will need to deposit additional funds for the separate matter to be used. The second concept is you can't spend what you don't have. So each client is limited to their own funds held in trust. A lawyer cannot borrow from one client to complete a transaction for another. An example of this is if a lawyer has $100 in trust for client A, but the lawyer needs to make a $200 payment for this client. The lawyer cannot borrow the funds from a different client matter first and have client A deposit the missing $100 at a later date. The third concept is there's no such thing as a negative balance. The client trust ledger should always remain positive. If the balance is negative, it may be a sign of negligence and at worst a sign of theft. Therefore, all negative balances must be investigated and dealt with immediately. The fourth concept is timing is everything. Each financial institution has their own policies and procedures. Even though funds may be deposited into a lawyer's trust account, it does not always mean it is available right away. The financial institutions may hold funds for a certain number of days before they are released. Therefore, understanding your firm's financial institution policies will help ensure you'll always have sufficient funds to meet your obligations and avoid issuing payments that may go on NSF. I've actually encountered this situation recently. A lawyer had deposited funds into their trust account the day of closing on a conveyance matter. The lawyer issued a check from their trust account to the seller's trust account, and then when the seller's lawyer tried to cash that check, it actually went NSF because the purchaser did not realize their bank had placed a hold on the original deposit of funds. Therefore, this created a shortage, because the lawyer was unable to deliver funds to meet his obligations, and then a shortage later was required. The next concept, the fifth one, you can't play the game if you don't know the score. This is in reference to keeping your records up to date. An example is if a lawyer hasn't recorded their trust transactions in a timely manner, the lawyer may not realize the lawyer may have dispersed funds which is not reflected on their accounting records. Therefore, when the lawyer disperses funds again at a later date, in their accounting records, it appears they may have more funds than they actually do allocated to that client. This may cause payments to be made in excess of what the lawyer holds for the client, leading to shortages. So in order to keep trust records as current as possible, at minimum, trust transactions should be recorded within 7 days. The sixth concept is the final score is always zero. Once a client matter is closed, the ledger should always have a zero balance. Any residue amount should be returned to the client or remitted to the law society under the law unclaimed trust fund provision. There are many reasons why these smaller balances may occur. They may be the result of miscalculating the required funds when determining the matter. You may have discounted invoicing, so there's additional funds in trust. However, as long as there are funds in trust in a lawyer's trust account, the lawyer is responsible for it. So a possible solution to avoiding these smaller balances at the end of matters may be to request a void check from your client at file opening. Therefore, once the matter is closed, there's always the option of depositing smaller amounts directly into the client's bank account. And the last and seventh concept is always maintain an audit trail. An audit trail is a series of documents and records that make it possible to trace what happened to the money a lawyer has handled. An audit trail is an important tool for tracking down accounting errors, and the key to making a good audit trail is to be as descriptive as possible. This is extremely helpful during an audit. If the records are descriptive, a lot of potential questions can be answered without having to ask the lawyer to remember what happened a few months or even years ago. And here's a quick recap of what I've just talked about. Trust funds are not your funds. Trust funds are the funds of the client. Trust funds belong to the client until they are earned by the firm and an invoice has been prepared and delivered. Any balances, no matter how small, in trust must be refunded to the client or remitted to the law society, and every penny counts. There is no materiality when it comes to trust accounting. The next section, setting up a trust account, will be presented by Krista.
Thanks, David. That's a great high-level overview of the important theories surrounding trust account. I'd like to welcome everyone and thank you for taking the time to brush up on your trust accounting concepts. Today's session is titled The Basics of Trust Accounting, and at the core is the lawyer's trust account. We hope these basics will help everyone who's new to trust accounts to get acquainted and started off on the right foot. And for many of you who already operate a trust account and some of this material is already familiar, we hope the next sections will serve as a helpful refresher. We're going to talk about the difference between holding your funds in your trust funds with a bank or a credit union. We'll talk about the letter you have to write to the institution. We'll discuss the differences between pooled trust accounts and separate interest-bearing trust accounts. We'll talk about your record keeping requirements and the storage of records. So the Law Society rules require lawyers to put funds in an account that are insured by Canadian Deposit Insurance Corporation or the Credit Union Deposit Insurance Corporation, and they are abbreviated as CDIC or CUDIC. Generally speaking, accounts held at banks such as RBC, TD, BMO, CIBC, etc., are covered by CDIC. And accounts held at credit unions, for example, Van City, Prospera, Blue Shore, Coastal Community, and many others, are covered by CUDIC. The one difference is that Coast Capital Savings became a federal credit union in November 2018, and it's now insured by CDIC. So a few factors that'll impact your decision when choosing a financial institution is, some of them are just logistical and practical. For example, the proximity of the branch to your practice or your home. The days and the hours of the branch will be a factor. Do you like to have longer hours? Weekend banking. Your existing bank relationship. If you already have a checking account or a credit card or a mortgage with one particular institution, it's likely easy and less cumbersome to open a general operating account or a trust account with that institution, as they already have done the KYC, know your client due diligence. And costs and products, and that's really a personal choice. But speaking about trust accounts specifically, what's the difference between CDIC and CUDIC? So banks, the main difference is the amount of coverage, insurance coverage, and the reporting to the bank that's required. So banks insured with CDIC cover up to $100,000 per client matter. So if you're holding $1 million in your trust account for one client matter, that matter is only insured up to $100,000. However, if you hold the same funds in a pooled trust account with a credit union, coverage would likely be the entire $1 million for that one client matter. The second difference is that CDIC requires lawyers who hold pooled trust accounts to make an annual report to their bank by May 30th each year. The purpose of the report is to advise the bank of the various balances that the lawyer is holding to ensure multiple beneficiary coverage. So if you're holding 5 different matters, by making that report, you ensure that the $100,000 worth of coverage is applied to each of the 5 matters individually. The report must include the list of the client matters and the corresponding trust balance as at April 30th each year. So be mindful if you have any outstanding deposits or checks that you must factor in. So your listing has to match the bank balance at April 30th. And be careful of confidentiality requirements. CDIC allows lawyers to substitute their client's name with an alphanumeric identifier, such as the client file number, as long as it allows you to and the bank to distinguish each client matter. Previously, one recent change is that previously foreign trust accounts held at a bank were not insured by CDIC. However, as of April 30th, 2020, foreign currency trust accounts at banks are now covered by CDIC. So regardless of whether you hold a US dollar trust account with a bank or a credit union, it is now covered. It is now insured. So moving on from the CDIC rules, this slide talks about one of the requirements you need to do when you're first opening a trust account. So you've decided on which bank or credit union. You'll need to deliver a letter to the financial institution to inform them of several things. So first of all, you need to inform them that any interest earned on the pooled trust account must be forwarded to the Law Foundation, not the Law Society. The Law Foundation is involved in different initiatives surrounding improved access to justice, legal research, legal aid, law reform, law libraries. So it's important to ensure that the account is set up properly, interest is being earned on the account, and it's being directed to the Law Foundation. The bank must also be aware that the account is a lawyer's trust account, and the funds are usually subject to solicitor-client privilege. The rules also require bank statements and trust checks to be marked with the phrase trust or trust account on the face of the statement and the checks. We have, you can see on the screen, there's a link to a sample letter template on the Law Society website. You can also find it by using the handy Google search and type in trust accounting resources, or go to the trust accounting resource section. You'll find another number of template letters along with this letter as well. So now we're going to talk about specific trust accounts. So the first broad category is called a pooled trust account. It's called pooled because the account typically holds funds for more than one client. As we said, interest earned must be remitted to the Law Foundation. And the reason why it's called pooled is that typically, a lawyer or firm acts for more than one client. It would be cumbersome to open up a new bank account every time there's a new client matter. So it's usually the first place funds are deposited, and you must deposit as soon as practicable. So what does practicable mean? It generally means within 2 to 3 days. And this is to ensure the funds are properly safeguarded and ready to be withdrawn when needed. So when you receive funds, ensure that you're depositing them as soon as you can and as soon as practicable. Sometimes a firm might receive money that's partly in payment of a bill and partly to be used as a retainer. If so, you need to deposit the funds first to the pooled trust account and then withdraw the portion that is related to the bill payment, leaving the retainer portion in trust. Funds that are directly related to legal services provided by a lawyer, only funds that are directly related to legal services can be deposited to the trust account. So if you anticipate holding funds, ensure that you open a pooled trust account and don't use another lawyer's trust account for that purpose. So through the years, we have several questions that come up frequently surrounding pooled trust accounts. And so we thought this would be a good chance to address some of them and help clear up some confusion. So the first question we get from time to time is, my financial institution told me the account is not interest bearing. So there's two possible reasons they would say this. It could be that the account was not set up properly when it was opened, or also that interest is calculated at the head office and the information isn't readily available to all employees at the bank. Either way, you should follow up with your bank to make sure that the account is interest bearing and the interest is going to the Law Foundation. When we conduct a compliance audit, we also do an interest confirmation. So the second question or issue that comes up is an issue regarding bank charges. So quite often, bank charges will go through the pooled trust account. Usually the lawyer or the firm would direct that they go through the general account, and sometimes either the bank makes a mistake or they're unable to do that administratively. So a good idea is to maintain a float. Lawyers are allowed to maintain up to $300 of their own funds in the trust account. And the purpose of this is to provide a buffer for these small bank charges that go through the trust account from time to time. Another question is about not seeing interest on the bank statement. So most institutions don't actually show the interest that's being earned on the statement itself. So it doesn't necessarily mean the interest isn't being remitted to the Law Foundation. It's, again, a good idea to follow up and check. However, some institutions will show the interest being deposited on the last day of the month and then a withdrawal of the same amount of interest on the first day of the next month. And that's usually correctly going to the Law Foundation. And the final banking related query that we commonly receive is about check ordering charges. So quite frequently when firms order checks, the bank will charge the account that the checks are being ordered on. So if you ordered trust account checks, the trust account will get charged for the check ordering fee. Usually it's over $100. So again, this is a really great situation where the float, trust account float, comes in handy. If you have $300 or so in the account, you'll be able to apply those charges against that. $300 in client funds are not affected. So separate interest-bearing accounts. The second type of account is a separate interest-bearing account. It's an account that you would open to hold funds for only one client. The interest goes to the client and not to the Law Foundation. Previously, we used to see separate interest-bearing accounts used quite a bit more frequently. However, in today's low interest environment, the costs associated with opening and administering the account usually is not offset by the amount of interest that the client would earn. It typically outweighs any interest benefit. So we are seeing very few these days, but sometimes there are cases where it's still appropriate. Usually if the amount being held is significant and you expect that you might need to hold it for a significant amount of time, then it's definitely to the client's benefit to have their funds segregated in their own separate interest-bearing account. Probably the most common example of separate interest-bearing accounts we see these days is for deposits being held for condo pre-sales. And often the requirement to hold in an interest-bearing account is written into the contract. So the funds in, we also call them SIBTAs. So the funds in SIBTA, the initials, belong to the client. So you must obtain instructions from them before opening such an account. The institution will also issue a T5 tax slip for the interest earned. That slip goes to the client for them to claim on their income tax return. So we recommend obtaining written instructions. The rules say you have to obtain instructions, but written instructions is always best. And lastly, unless the account has monthly bank statements and checks, the funds will have to be deposited into the pooled trust account before being sent to a third party. So for example, if you're holding a GIC or a term deposit in trust for a client, the funds will have to be transferred from the GIC to the pooled account before being paid out to the third party and leaving the law firm. The obligations between separate interest-bearing accounts and pooled accounts are different. We're going to move on now to record keeping. So let's take a look at record keeping and think, how is your practice maintaining records? Do you use, there's really four main methods that we see. Accounting software specific for law firms. So examples would be PC Law, Easy Law, Clio. There's also general accounting software, sort of the off-the-shelf packages like QuickBooks. We also see Sage used as well. Number 3 is manual computerized spreadsheets, for example, using Excel or using Word. And 4 is manual paper records, so the one right system. We find now most firms are maintaining electronic records. And using computer software will often increase efficiencies, but it's not a guarantee that your records will comply with the rules. Over the years, we've conducted thousands of audits and have seen varying degrees of compliance with both manual and electronic records. So knowing the Law Society rules is your best bet for ensuring compliance, regardless of the method of record keeping that you choose to use. Sometimes we have lawyers or administrators or bookkeepers asking auditors to recommend what software to use. So we're unable to recommend a specific brand, but we can say that choosing a software that is geared specifically towards law firms often makes the compliance requirements easier. And it also helps with other aspects of managing the practice, such as reporting, time tracking, work in progress, generating bills, and some of the programs also include a function to be able to calculate the trust administration fee. So making the determination on software, you will obviously want to consider the cost, the area of law you practice. Is it high volume or low volume in terms of your trust account frequency, the size of your practice, and even the availability of software support and requirements to update to new versions of the software. So I'm going to move on to trust accounting records. So now that we've talked about how to keep your records, we're going to discuss what you need to maintain. So if you maintain a trust account, you need to maintain the following 5 records, and I'll talk about each of these items on the screen in a little bit of detail. So the first is a trust book of entry, and it's also called a trust journal or a trust receipts journal, or for those with accounting background, the trust account ledger or trust account general ledger. All of those different terminologies can be confusing, but if you think of it as the trust book of entry, that's how it's referred to in the rule. So this part of the accounting records records the flow of all transactions of all your clients in date order. So besides the date, you must record the amount of funds deposited or withdrawn, the source of funds received, the form of funds received, the name and client number, and the check number. So just a quick word on source and form. So the source is, where did the money come from? Who did it come from? The name of the person or entity providing the money. The form of funds is, how did you receive it? Did you get a check, a bank draft, cash? Was it a wire transfer? Was it an e-transfer? Direct deposit is not a source of funds, it's a method. Somebody can direct deposit a check into your trust account. In that case, the actual form would be check. So for example, if you were going to record a certain transaction, it would look like this. January 1st, 2020, deposit 8,000 check from Jack Smith for Jack's file. And then a payment out might look like January 2nd, 2020, issued trust check number 322 for 1,000 to Sally Cameron for Sally's file. So that's an example of a trust book of entry. So client trust ledgers, on the other hand, tell the story of the individual client. This is the record that's organized by client. So if you wanted to see all the related transactions for client Jane Smith, you would look on Jane's client trust ledger. For example, you might see a deposit for Jane on April 1st, and then trust withdrawals on April 2nd and April 3rd. All of these transactions relate to Jane's file only. You would also include all of the details for each transaction, including the date, the amount, the source of funds, the form of funds received, the payee, and the check number for payments out. And you would always consult the client trust ledger before making a payment out in order to ensure that it's up to date and you have the funds for that client. So the next item on the list is the trust transfer records. Depending on the area of law you practice, you may need to transfer funds from one client matter to another client matter. An example of this would be frequently used in conveyance practices, where somebody selling the home would use the sale proceeds from their house sale to purchase a new house. So the sale proceeds would be needed, and you would need to transfer them over to the purchase file, two separate files. So you need to maintain trust transfer records that indicate the client name and the client number of the originating file and the destination file, an explanation for the transfer, and a lawyer's written authorization for the transfer. This is really important to see that regardless of who's doing the bookkeeping and the record keeping, you need to see a lawyer's authorization authorizing the transfer of funds from one matter to another. So monthly trust reconciliations, we're going to do an upcoming section on those, so I'll discuss that in more detail later. And lastly is the valuable property listing. Many firms don't keep valuable property, but if you do, you must maintain a list of valuables you're holding for each client. And this has to be included with the reconciliation records each month. So valuables are defined in Rule 1, and they mean anything of value that can be negotiated or transferred, including but not limited to A, securities, B, bonds, C, treasury bills, and D, personal property. And just a quick note, that was a lot of information. If you want to read about it in more depth, or there was something that you didn't quite get right this first time around, the Trust Accounting Handbook on the website has detailed information on all of those records we just discussed. And that's found in the Trust Assurance Resources on the Law Society website. So we're going to switch gears a little bit and talk about the general account. Maintaining the records of your general account is almost as important as maintaining records for your trust account. I say almost as they're your funds, so there's a little bit of discretion, but it is very important to know, to have the records up to date and know what's going in and out of your general account as well. So the general account is really your business operating account. It's where you deposit the fees that you've earned and payments for operating expenses, and keeping your records current and accurate will help you run an efficient practice. So just like the trust account, you need to maintain a record of all transactions in your general account. This is called the general book of entry or the general account ledger. The transactions need to be recorded in date order. Besides the date, you must record the amount deposited or withdrawn, the source of funds received, the name of each payee, and the check number for the amounts withdrawn. The second accounting record that you have to maintain with regards to your general funds is the accounts receivable subledger. So the accounts receivable is where you record all bills issued by client matter and the payments you receive on these accounts. Anytime a lawyer issues a bill or receives a payment of a bill, either from the client directly or transferred in from a retainer held in trust, the transaction must be recorded in an accounts receivable subledger. It's similar to the client trust ledger in that the records are organized by client. A common misconception we sometimes find is that lawyers are not maintaining the proper accounts receivable records if they don't have outstanding accounts receivable. So for example, you take a retainer for a client, you do the work, then you issue the bill, and then you pay yourself from trust, and there's no outstanding amount. So you don't have an outstanding accounts receivable, but you still need to keep the accounts receivable records, the recording of the mirroring of that transaction on the general side. So a quick example, I'm assuming I'm a lawyer and I provide legal services. I issue a bill for $499.50 and I record that in my accounts receivable subledger for that client. The client pays me with a $500 check. If I deposit the funds into the general account, I'll have a 50-cent overage or credit balance in the accounts receivable due to that overpayment. I'm not allowed to keep overpayments in the general account regardless of the amount. So the 50-cent balance will have to be put in my trust account and returned to the client. It's important to review accounts receivables on a regular basis to ensure there's no trust funds, accidental overpayments. So when you receive that initial payment, the proper method would be to deposit the entire $500 into trust and transfer $499.50 to pay the bill. So there's also records that you must maintain for both trust and general bank account. These are your source documents. So they include validated deposit receipts, and this can mean a stamped deposit slip in your deposit book, a transaction receipt from the teller or an ATM receipt, and it also includes deposit confirmations provided online when doing online deposits such as e-transfers and remote capture deposits. You also need to maintain monthly bank statements for trust and general. So if your bank doesn't mail you a paper copy, you have to go online and obtain a copy, or you can visit your branch and ask the teller to provide a printed copy. A common misunderstanding is that being able to access banking records online meets compliance. meets the compliance requirements. That in itself isn't sufficient, as the statements are generally available only for a limited amount of time. Say frequently it's 12 to 18 months, and then they're no longer accessible by the firm or the lawyer. So as a lawyer, you need to take the extra step to, when obtaining records online, to download them or print them so that you have custody of the records. You own the data rather than having it under control of the bank. So you also need to obtain the front and back images of all canceled checks, including general checks. Sometimes we get asked, what are canceled checks? Basically, it's just the negotiated check, the check that has cleared through the bank. So most institutions do include the image of the front and the back with the bank statement. If they don't, I would recommend contacting your institution and getting them to start including those images. Sometimes it's just that it hasn't been set up properly on the bank statement function. You also need to obtain images of the fronts and backs of any certified checks. So if you issue a check and the payee has it certified, sometimes that check doesn't come through with the bank statement, and you need to request it specifically from your institution. And finally, you need to keep copies of all the bills that you issued and bills that were issued to you. So your vendor invoices, bill payment invoices, and bills that you've issued to your clients. A couple other records that you need to maintain are the cash receipts book of duplicate receipts and the EFT requisition form and confirmation. There's strict requirements surrounding the accepting and refunding of cash. So you'll need to keep a cash receipts book of duplicate receipts and make a receipt for any cash received or refunded. This pertains for cash deposited into your trust account or general account. And ensure that all staff are fully trained on the cash rules and know the limit, when to accept, when to refund. The cash receipts have to include the date, the amount, the payer name, the client number, and 2 signatures. The person providing the cash and the person accepting the cash. The cash receipt book must also be in duplicate form. Some law firms choose to use a triplicate form so that a copy can be maintained in the client file as well, which is a good idea, but not a requirement. Once the required information is recorded on the cash receipt, give the original to the payer and keep the copy in the receipt book. And please don't rip it out. The Law Society has also produced a really great webinar on lawyers' anti-money laundering responsibilities and cash requirements. The link to this webinar is also on the website, and I really encourage everyone to watch it for a more in-depth discussion on the cash rules, TIV, and other anti-money laundering measures. And if you withdraw funds electronically from trust, there's a very specific set of rules you must follow, and there's an electronic funds transfer requisition form and related confirmations that you will need to maintain. David's going to discuss this in the next section. So let's turn our attention briefly to the storage of records. So generally speaking, you need to keep records for at least 10 years after the final accounting transaction. Records can be stored in electronic, handwritten, or printed form. And you must keep your current records on site. So that's records for the current and previous 2 years, making up 3 years of records at your chief place of practice. So physical records must be legible, and electronic records must be printable on demand in a format that can be read. And you must also retain custody and control over your electronic records, which is another reason why you must download and print or save the bank statements and cancel checks when accessing them through online banking. Without doing so, the bank retains custody and control over the records. Now, storage providers. The rules permit lawyers to store their records with a storage provider if, as mentioned, the lawyer retains custody and control of the records, the ownership doesn't pass to another party, and the records can be produced on demand. The executive committee has the power to declare that a specific entity is not permitted to be a storage provider, but as of now, there has been no such declaration made. Something that many firms are using and considering these days is using cloud-based storage. So the Law Society has a 14-page cloud computing checklist on the website. It was updated recently, and you can find it by using the Google search on the website. Type in the phrase cloud computing, or simply cloud. And some questions that it addresses are, am I able on demand to produce records in a format that complies with the Law Society rules? Does the system record the creation date edits, the dates that such edits were made? Does the cloud provider have adequate technological, contractual, and policy safeguards in place to ensure that data may be confidential and subject to privilege is properly protected? What's my disaster recovery plan? Where are the cloud-based servers located? Will my data comply with BC's Personal Information Protection Act or Federal Personal Information and Protection Act? How will I get consent from my client to store their data in the cloud? If you have questions regarding cloud-based storage after reading the checklist, please contact the practice advisor at the Law Society. Their information is also included on the website and on a slide at the end of today's presentation. So now I'm going to turn it back over to David, who will talk about how to operate a trust account.
Thanks, Krista. Now we have the information to set up a trust account. In this section, we'll discuss how to operate the trust account. So what type of funds can be accepted into trusts? A wide range of different funds can be accepted into trusts. Checks, certified checks, bank statements, credit cards, debit payments, electronic funds, and cash can all be accepted into trusts. There are some additional requirements for some of the form of funds, such as cash and electronic funds, which will go into further details in the upcoming slides. So when to deposit funds? The rule states trust funds should be deposited as soon as practicable. Ideally, this is the same day or at the very maximum 3 business days. For accepting electronic deposits into trusts is becoming more and more popular these days. In order to meet the requirements of electronic deposits, the lawyer must obtain a confirmation in writing from the financial institution or the remitter within 2 banking days of the deposits. So for example, if your client sends you an e-transfer, a lawyer should retain the e-transfer email as confirmation. And the same kind of front, if you receive a wire into trust, it's probably a good idea to follow up with your financial institution and obtain a wire confirmation so you have all the required information. And lastly, it's also important to follow up on third-party deposits or direct deposits into your trust account. A common example of this is if your client goes to the bank and deposit funds directly into a lawyer's trust account. The lawyer will need to take the appropriate steps in order to determine the form of funds received. For example, if the client deposits cash, all the cash rules are applicable, such as issuing a cash receipt, as well as not accepting cash greater than $7,500 unless it's for fees and retainers. The Law Society has disciplined lawyers for accepting cash and making use of it when they were not permitted to do so. So that's something you want to look out for. What type of funds can be withdrawn from trusts? Payments on behalf of the clients. So if you're helping them with a conveyance matter or settlement, you're able to pay out funds for that matter. The second one is property of the lawyer. So this is kind of talking about the lawyer's float balance. If a lawyer wants to kind of reduce the amount of float they have, the float balance in the trust account, they have the option to withdraw those funds from trusts. The third one is an account as a result of a mistake. So if a lawyer accidentally deposits funds that are meant to go in the general account into trust, they can remove the funds from trust and move it back to the general account. Next one is to pay a debt of a client to the lawyer. So if a lawyer has issued a bill to their client, they're able to withdraw funds from trust, transfer between trust accounts. Some lawyers may have multiple trust accounts with different financial institutions. Maybe at some point in time during the client matter, the lawyer will need to consolidate the funds into one bank account. So you are able to write checks from one trust account to another to kind of consolidate funds. The next one is due to the law foundation. So this is the interest from the pool trust account. So this type of withdrawal is typically done monthly, and most of the time you won't see it on the bank statements. Typically, this is set up when you open your trust account, as Krista mentioned, and the funds will just be automatically remitted to the law foundation. And then the last one is unclaimed trust monies remitted to the Law Society. So if you have unclaimed trust monies in your pool trust account, you complete an unclaimed trust form you complete an unclaimed trust money application form and is accepted by the Law Society, you can then issue a check to the Law Society to remit those funds. So how do we withdraw from a pool trust account? The first requirement is the trust check must be marked trust. So if your trust checks don't say trust, you need to, when you can, for now, you can manually mark them as trust. And then when you place kind of your next check order, make sure your financial institution knows that you want to have the checks clearly marked trust. The second one is electronic transfers. You want to ensure that you have the correct online banking platform with a dual password authentication process. If you ever want to wire money out of trust. The next one is a letter of directions to be remitted to the Law Foundation. So we've discussed this previously. And then the last one is withdrawals via cash. So if a cash refund is required, you may withdraw cash from the trust account. However, these are in very kind of rare circumstances. If you want more information about the cash rules, I would highly recommend you look out for the second installment of the trust accounting course, which goes into the cash rules in quite detail. And then the last one is if you want to withdraw from a separate interest trust account, unless that account has its own trust checks and bank statements, you are required to move the funds back to the pool trust account prior to withdrawing any funds out of this account. And here are a few things to be cautious about. If you give non-lawyers the ability to sign checks that require 2 signatures, we highly recommend that you design internal control so that the practicing lawyer signs first and then the non-lawyer. This will ensure trust checks are not inadvertently released without a lawyer's signature. Also note that retired lawyers and non-practicing lawyers are not permitted to sign trust checks or electronic transfer requisition forms. And lastly, if you are a sole practitioner and you are planning to retire in the near future, you must close your trust account before you contact Member Services Department to change your membership status as a retired lawyer. And before withdrawing funds from the trust, you want to ensure that all records are current. This will reduce the chances of shortages and ensuring that you have sufficient funds in your accounts to disperse. And the next topic is payment of fees from trusts. So a lawyer must first prepare a bill and deliver it to a client before withdrawing funds from trusts for the payment of fees. Bills sent via email are considered delivered once you've hit that send button. If a client fee is in dispute, the funds must remain into trust until the matter is resolved. And lastly, a lawyer cannot use trust funds if the funds have been designated for a specific purpose. For example, if the money in trust has been allocated to pay a settlement, these funds cannot now be used to pay the lawyer's fees. The client will have to deposit additional funds to pay those fees. And here are the rules surrounding recording transactions. For trust transactions, you are required to record transactions within 7 days. And for general transaction, you have up to 30 days to record a general transaction. And these slides relate to billing, fees, and disbursements. When issuing a bill, it must be delivered to the person in charge, and it must be signed on behalf of, must be signed by the lawyer or on behalf of the lawyer, or sorry, the bill must be delivered to the person in charge, and it must be signed by or on behalf of the lawyer or accompanied by a letter signed by or on behalf of a lawyer that refers to that bill. And the bills must contain reasonably descriptive statements of services with lump sum charges and a detailed statement of disbursements. A lawyer must clearly and separately detail the amounts charged as fees and disbursements. So there must be two different balances, one for fees and one for disbursements. For disbursements, disbursements must be reasonably incurred in the circumstances the client matter is authorized by the client. This one's important. It must be billed at actual rather than estimated costs. So for example, you can't do kind of a blanket estimation fee on a disbursement like photocopying. You will need to support your charges. And lastly, disbursement must be properly described in the detailed statement of account. The client must be aware of what they're paying for. So kind of blanket statements to don't also work for disbursements. And as for the billing records, once you've issued the invoice, a copy of that invoice must be kept in a centralized location, and it must be filed either in chronological, alphabetical, or numerical order. Also, if you ever end up, say, modifying an invoice, maybe you decided to reduce the fees or there was an error, that modification date needs to be included the date you actually modify that invoice. Next ones we're talking about is trust shortage. So trust shortage occurs when there's insufficient funds held to the credit of a client. Many people get confused by the idea thinking that a trust shortage only refers to when the bank balance is in overdraft. This is not always the case. I'll go over kind of a few examples that will illustrate this point. So in this example, Jane has $100,000 in trust. John has $200,000 in trust. So the total amount of trust is $300,000. If you pay out $150,000 on behalf of Jane for property purchase, do we have a trust shortage? The answer to that is yes. It's because Jane only had $100,000 in trust, and you paid out $150,000. So even though the bank balance says $150,000 still remains in trust. If you look at Jane's client ledger, there would be a negative balance of $50,000, and that's where the shortages occurred. So now that a shortage has occurred, what is the next steps? The next step is you must eliminate that shortage immediately as soon as discovered. So in this case, the firm should basically move the $50,000 shortage from their general to their trust to cover that shortage until the situation can be rectified. And because the shortage was greater than $2,500, a written report to the executive director is required, detailing all the details and circumstances of that shortage. We did have a case where a BC lawyer reported to us a counterfeit check cleared his account. Since he reviewed his account online on a daily basis, he was able to report this to his bank, and within 48 hours, the bank credited his account. To protect yourself from kind of unauthorized withdrawals, we recommend that you review your accounts daily, you review your agreement with your bank, you report missing funds to your bank within the required time period for disbursements, and you obtain commercial insurance against fraud risks that are covered by the Lawyers Indemnity Fund. And here's a recap on shortages. Shortages must be immediately eliminated upon discovery. A written report must be made to the executive director if the shortage is greater than 2,500, like in our example. And the other situation is if the lawyer is unable to deliver when due any funds. So, for example, if the lawyer issues a check and it goes non-sufficient funds, it could be there wasn't enough funds in there. Potentially, the bank held deposits. Whenever a check goes NSF, a report is required. There is no threshold amount for this type of shortage. And even for shortages less than 2,500, it is, although you don't need to report it to the Law Society, you are expected that the shortage are corrected as soon as discovered. Lawyers have an ethical duty to inform the Lawyers Indemnity Fund of all circumstances that may lead to a claim. If you are not able to immediately correct the shortage, you should consider contacting the Lawyers Indemnity Fund. Their contact information will be available in one of the end slides as a resource. So I'll pass this back to Krista, who will finish presenting this material, and she'll go through the trust reconciliation exercise.
Thanks, David. I really appreciate that discussion on shortages. It's really an important topic that everyone needs to be well versed on. And just to expand on a couple of the items that you were talking about, if a lawyer does discover a shortage, as in the example that we use with Jane paying out too much money on Jane's trust account, if the lawyer is unable to correct the shortage by getting the money back from Jane, they would have to cover it from the general funds. But most of the time we see that the shortage is able to be corrected by other means promptly. And just to expand on a few ways that we see shortages, it's frequently, it's not always the law firm's fault. There's a number of ways shortages can rear their heads, and that's by sometimes money gets deposited, bank errors. For example, a firm might have more than one pooled trust account, which is pretty common with conveyance practices. And the deposit book for the pooled trust account in TD is used, but it's recorded in a different bank. So the trust accounts end up in the wrong pooled trust account. Or an instance where it may be the bank's fault is that you take a deposit to the bank and they erroneously deposit into the general account instead of the pooled trust account. And sometimes, as David mentioned earlier on, due to bank holds, if you're not aware that a bank has put a hold on funds and try and pay out on that, and the check comes back NSF, that would be considered a reportable shortage. So it's just something that you can really guard against by keeping up-to-date records and reviewing your account frequently. So I'm going to move on, and I have quite a bit to say about unclaimed trust money. I think it's a source of frustration for many lawyers and firms, and hopefully some of this information will be useful in dealing with these niggly balances. So the key with trust funds, as David said earlier, is to deal with these remaining balances on a file before they become a problem and take a lot of administrative time to deal with it. So have firm processes to review the client trust listing for inactive balances at least quarterly and ideally monthly, depending on the size of your practice. We have come across many instances during compliance audits where a firm is holding large volumes of stale funds, and sometimes the funds build up over time with a busy sole practice. And it can also be a problem with medium and large firms, and sometimes a factor of lawyer turnover. So common ways we see excess funds lingering trust files is sometimes small amounts being held as holdbacks for payment of utility or strata fees or fines, insurance binder estimates where there's some amount left over. Sometimes there's calculation errors, and also sometimes it's retainers being held on a file and a remaining amount that was never billed out or returned to a client. So as I say, the best advice I think I can offer here is to look after the little balances early before it becomes difficult to find the client and before you accumulate a large number of inactive balances. You can do this by ensuring the billing amounts are accurate. Sometimes we see pennies left over due to rounding issues, and I know this is infuriating to deal with, to try and return a penny to a client. So eyeball your trust ledger and your bills and make sure they're accurate. You'll also want to review the file on completion to ensure the little balances are paid out appropriately when the file is finished. Don't let them linger. So the accounting concept of materiality doesn't apply to trust funds. So all funds have to be accounted for and dispersed properly. That's when those little balances become irritating, but nevertheless, they have to be handled properly, the same as any other funds. So we have seen in compliance audits where a firm has done an improper cleanup of old balances. We call this souping of trust funds. And it occurs when funds are improperly taken into the firm's general account, and it's usually a matter of convenience rather than looking for the proper pay after a long period of time has lapsed. It is time consuming. However, this practice of scooping has led to discipline in several instances. So an example where this sometimes happens is a lawyer realizes that he or she has 10 or so client balances with varying amounts under $20 that have been sitting in the trust account for several years. So regardless of the balance, the proper course of action would be to seek out the payee and return the funds. If there's an outstanding account, you can apply the funds against that account. If there are outstanding and unbilled disbursements, it may be proper to bill the client for those disbursements or appropriate to bill the client for those disbursements and transfer the money to the general account, depending on the circumstances. But it wouldn't be proper to create a dummy bill for, and I'm using air quote, office expense or photocopies that weren't incurred and then transfer the money to the general account. And it's also considered not proper to bill a client for your efforts to locate them. There is on the website a useful discipline advisory on billing practices that addresses some of these issues. So what do you do? Say that you do have balances that have lingered. So basically, well, you need to return them to the rightful owner, the proper client or the payee, and make efforts to find that person. If you're unable to find the client after trying for 2 years, you may make an application to the Law Society to pay the funds to the Law Society. Bear in mind, not all applications are successful. So for example, the Law Society cannot accept funds prior to the 2 years of attempting to locate the client, or if there are unfulfilled undertakings with respect to the funds. In other cases, the application may be denied if the Law Society conducts their own search and is able to find the client. They will likely direct you to try again. So what happens with the unclaimed trust funds when they are accepted by the Law Society? So the Law Society holds the funds in trust for 5 years, and then they get forwarded to the Law Foundation. However, if a client resurfaces at any point, they can make an application to have their funds returned to them. During an audit, the auditor will ask to see what actions you've taken with respect to any lingering balances, inactive balances. So we recommend that you keep detailed notes to support the actions you've taken with the corresponding date and any contact you've made with the client. So monthly trust reconciliations, an important topic. It's near and dear to the hearts for many bookkeepers and accountants. Preparing trust reconciliations is one of the most important things you need to do if you maintain a trust account. It serves as a tool to help you detect errors and shortages, allowing you to deal with them promptly and timely. It requires a lawyer to compare what is recorded in the records to what is in the bank and find out and correct any errors. So why would there be a difference between what is recorded in your records and what is in the bank? So let's say, use a simple example. Let's say you write a trust check to your client, but the client doesn't cash the check until 2 months later. So you've issued a check, you would record that in your client trust ledger, in your book of entry, and so your records would show an outgoing disbursement of funds. However, that hasn't cleared the bank, so the bank will have a higher balance because the check was not yet negotiated. Another reason to complete recs is that financial institutions sometimes only give their clients 30 days to report any inaccuracies. So while you may have not made a deposit or withdrawn any funds from trust in the month, there could be unauthorized transactions in your account that you would want to be aware of and advise the bank about. So make sure to identify, investigate, and correct all discrepancy within 30 days of month end. And to show the trust reconciliation is prepared in a timely manner, you have to indicate the date the trust rec was prepared. So on the reconciliation, you have to make a record of the date that you completed it. And it must be within 30 days of the month. So trust reconciliations have three components. It requires you to reconcile balances from three places. So the bank statement, the trust liability listing, and the control account. That's the trust book of entry. It has accountants regularly reconcile two balances for general operating accounts, the bank statement to the control account. But with trust accounts, the additional element is comparing the listing of trust balances. The rule requires all reconciliations to be supported by a number of supporting documents, backup documents. And that is the bank statement, the trust liability listing, a written explanation for any errors or differences, the listing of SIPTA, separate interest-bearing trust accounts, and a listing of valuables. So please ensure that you keep a paper or electronic copy of all supporting documents. We do look at them during compliance audits. So what happens if you're doing the reconciliation and you find the three numbers do not agree? What happens when you have a discrepancy? So you must immediately find out what causes the discrepancy and make necessary corrections. Errors shouldn't be carried over to subsequent months. So let's say you open a new trust account on April 1st. You have a trusted staff member deposit a $1,000 retainer into your trust account on April 30th and record the deposit in your accounting records. You have no other transactions that month. On May 13th, you receive your trust bank statements for April, and the balance is zero throughout and no transactions. So you review your accounting records. You see a deposit of $1,000 was recorded in your accounting records on April 30th. So your records say you have $1,000 in trust, but the bank says you hold nothing. So you have a $1,000 discrepancy. This is where you need to investigate for the possible reason. There could be a number of reasons that there is a difference. Perhaps, hopefully not, but perhaps your staff person forgot to deposit the check. Or maybe the deposit was made, but due to timing of the bank's cutoff, the deposit was not shown on the bank statement on April 30th. It will be shown on the bank statement for May 1st. Or even perhaps the bank made an error and deposited the funds into the wrong account. In any case, you would need to find out if any action needs to be taken. If it's item number 1 or 3, you would need to take action. If it's number 2, just due to cutoff, you would see the deposit on the May 1st on your bank statement for May. Completing reconciliations alert you to things that are not quite right, and now you can take steps to find out what needs to be fixed. Now, we're going to look at an actual trust reconciliation. So this exercise, the complete trust reconciliation exercise and answer key, is available on the Law Society website under the Trust Accounting Resources section. And it also includes a list of exceptions. So if you wish, you could pause the playback of the webinar here, go to the website, download or print the exercise and try it for yourself. Or you could listen on and try the exercise afterwards. I'll explain the 3 main parts of the reconciliation and go through the steps for completion. So the first box that we see at the top here labeled trust assets is the trust assets or bank balance. This is where you record the balance of your bank and any adjustments as at the month end that you're reconciling. The second box is the control account. This is the month-end balance for your trust book of entry. And the third section, this is the section that is unique to trust reconciliations and not just bank reconciliations. This is the listing of all individual balances you're holding for clients. All the balances that you're holding as at, in this case, February 29th, 2020. This is often the missing piece that we see when we're out on audits. The two top parts are often completed and correctly, and the trust liabilities listing section is sometimes forgotten or not included. But it's just as important as the other two parts of the reconciliation. So to start the exercise, go through the instructions once you've printed out from the website and the source documents. You'll find where the exercise includes a page of instructions, a template for completing your reconciliation, a mock bank statement and canceled checks, a 1 page with 6 individual trust ledgers, and a trust book of entry, and finally a receipt, a cash receipt. So go through those documents, and first of all, do the control account. That's the middle section, section 2. Then you do the trust liabilities. Look at your trust ledgers and write down the month-end balance for each balance you're holding for clients. And we find it really important to include the date of the last transaction as well. This is part of reviewing your balances to see if any of them are old and lingering. As you can see, there may be some balances here that you might want to follow up on. I'm looking at Larissa Lyon. So once you have the list of trust liabilities, do the trust assets. What's the bank statement balance? Are there any checks that didn't clear that month? And are there any outstanding deposits that didn't clear that month? Are there any bank errors? When going through this exercise, you might find that some things look a bit off to you, and you would be right. We've included a number of exceptions and errors with this exercise. So I challenge you to see how many you can find before checking the answer key and the explanation. Make a list of anything that you find that seems wrong or against compliance or the trust accounting rules. So I'll start you off. You might notice that on the slide on the screen that the client Bruce Bear has an overdrawn balance of $50 in his trust listing. This indicates that you're short of funds for Bruce and have somehow overdrawn his account. That's something that needs to get sorted out and corrected. So to summarize and to go through a few things to watch out for. So when you're completing your reconciliations, you'll want to watch out for these items and correct them. So bank errors, note them on the back and decide how to correct them. This may be by allocating funds from the float, or you might need to deposit some funds from your general account to cover an error or a bank charge. Sale dated checks. So this kind of goes along with the inactive balances and unclaimed trust funds. You need to make a note of when all outstanding checks were issued and take action to follow up with the payee before the check goes stale. Outstanding deposits, and this is really key. If you've received trust funds for deposit and they didn't clear, it's really important to follow up and discover why. It may be as simple as missing the bank cutoff, as we talked about in an earlier example, on the last day of the month, and have the funds posted to the account the following day, or it could indicate a shortage. Someone forgot to make the deposit, or the deposit was made to the wrong account, or even the general account. So it's important to follow up with this right away. You might also discover unrecorded transactions. For example, there's a transaction in the bank that didn't make it into the trust accounting records. So you'd need to post an entry and correct this. Errors carried forward. This is something you should be on top of. The point of doing the recs is to uncover errors and correct them in the same month. And finally, our old favorite, inactive trust balances. Each month is a great opportunity to review the listing and make a note of any balances that need to be addressed. And as I've said, it's easier to take action earlier in the file than let the funds linger on for months or years, by which time the client may have moved away or is difficult to track down. And it involves a lot of unnecessary administrative time. So just some brief best practices with trust reconciliations. So even if a bookkeeper or an accountant or administrator is completing the reconciliations, the responsible lawyer should always review, sign, and date the reconciliation. Follow up with any items on the reconciliation that seem unusual. Investigate any errors or brought forward carryover items. Correct any negative balances, overdrawn balances on the trust liability listing, and include detailed explanations for any discrepancies. Review stale dated checks and inactive trust balances. That concludes the section on bank reconciliation exercises and information about the bank reconciliation. And I'll mention the Trust Accounting Handbook again. We do have information about that in the handbook. And also, you're welcome to contact the Trust Assurance Department with any questions that you might have. So moving on, I'm just going to briefly touch on fiduciary property. It's one of the final topics we'll discuss today. So if you read the definition, it's a separate category of trust funds. It's a separate category from trust funds, and it involves a lawyer acting as a representative in a representative capacity or as a trustee. In addition, the appointment has to be derived from a solicitor-client relationship. So some common examples include executor, power of attorney, committee, trustee, personal representative. There are rules that lawyers must comply with if they have fiduciary property. So let's see what they are. So currently the rules allow lawyers to keep fiduciary property in a lawyer's trust account, but the records must comply with the related trust accounting rules that we've covered today in the webinar. Fiduciary property is also allowed to be kept in a separate account that's not a lawyer's trust account, a fiduciary account. If so, the lawyer will need to maintain a minimum records, such as the accounting of the property, the bills, the bank statements, counsel checks, and a list of valuables. These are covered under Rule 3-55. Regardless, you need to keep accurate records of the transactions and provide them to an auditor during a compliance audit. So important to note, there are upcoming rule changes with respect to fiduciary property. So in September 2019, the benchers approved a rule change in principle to ensure that trust accounts are used only for funds directly related to the provision of legal services and that lawyers are not facilitating money laundering. The rules will be changed to prohibit lawyers from depositing fiduciary property into a trust account. So if you do have fiduciary property coming your way, or you're currently holding fiduciary property in trust, you should consider depositing the funds into a fiduciary property account and not a lawyer's trust account. The practice advisors at the Law Society can also provide guidance on this as well. And now I'm going to turn it back over to David, who will wrap up today's webinar. And I thank everyone for listening and taking the time to expand your knowledge or take this refresher on trust accounting. Thanks, everyone.
Thanks, Krista. There's been quite a bit of information that's been presented today. Here are just kind of a few key points from our presentation that I would like to highlight. The Trust Assurance Department protects the public, in particular protects funds entrusted to lawyers by their clients. Trust funds are not your funds and they belong to your client until earned. Every penny counts, so there's no materiality, as you've heard throughout this presentation, and you must deal with those small balances. Trust accounting rules are not optional and they must be followed at all times. And you must prepare and deliver a bill to your clients prior to withdrawing funds for the payment of legal fees. And lastly, any balance left in trust after a matter complete must be refunded to the client or remitted to the Law Society as unclaimed trust money. General rule of thumb, the balance should be zero at the end of all client matters. In this slide, there are links to various resources. The first one, if you want to review where the trust accounting rules are, they're in the member's manual as well as they're available online. The second one is a link to the trust accounting resource page, which has various forms and checklists. And then the last one on this slide is the contact information of the Trust Assurance Department. So if you have any trust related questions, you could always phone or email your questions in, and someone from the Trust Assurance Department will contact you with a response. In this slide, if you wish to speak with a practice advisor, here's the contact information. Our practice advice department is staffed by experienced and dedicated lawyers who provide confidential advice to lawyers, except in the cases of trust shortages. And a few more links. If you're interested in cloud computing, there's a checklist you can follow to make sure you're in compliance. The next one is discipline advisories. If you want to keep up to date on those, as well as e-briefs. The next one below that is the application form. If you do have unclaimed trust funds and you want to kind of start the process, the link there will provide you to the application form where you fill the information. And then the very last one is the Trust Accounting Handbook, which has a lot of the information we have presented in this that you can kind of read through. And lastly, Krista and I want to thank you for listening to today's presentation on the basics of trust accounting. Thank you.